Look, Greg, thank you very much indeed for coming on. Look, you co-wrote the chapter in Scaling Up with Vern, and then you got this Simple Numbers, and then recently you've done Simple Numbers 2.0.
Correct.
Read them both. I've got a quick question for the audience. The audience can stick this in chat. Who's read? If you could just say in the chat, who's read Simple Numbers 2.0 or just Simple Numbers? That would be fantastic if people could let us know that. Okay, thank you. Okay, first few people there haven't read either it, right? Okay, so that's fantastic. We've got a virgin audience. People are keen to come and listen to what you have to say, but they've never read your books. Well, potential sales on Amazon through the roof.
There you go.
But what you've got some concepts that you want to. I'd really like to talk about and dig into labor efficiency ratio and launch capital. But why don't you just wind back and say, look, you're an accountant, but you're an unusual accountant. You come at the numbers from a different perspective. So why don't you just say how you come at these things?
Well, I think the vast majority of businesses struggle to understand financial truth. I mean, that's really the epidemic crisis in business data today, especially on the privately held business world, because there's just not a really developed sense of, what truth is. I mean, you've got advisors that are, directing people for tax minimization, and it distorts data. You've got times that entrepreneurs are trying to scale and they're 100% focused on revenue. But it's like, well, are we profitable though? And how do we make money? We can't just be changing 4 quarters for $1 and think that that's success. And so what it really kind of led to was a career that, I'll just tell you, basic accounting is pretty boring. So so it was like, okay, well, what can I do that actually, one, is a little more interesting, but two, makes a bigger difference in the world in terms of helping people be successful in what they're doing? Because there's nothing worse than good, hard, blood and sweat and tears that doesn't really accomplish anything. And so as I started studying my clients who were successful in spite of me and the things that I knew, okay, well, what are they looking at? Why is this working for them? And people in the exact same industry are failing at that thing. And then as you start to realize it's not what we're taught as accountants in college and in accounting courses of debits and credits and, mindless, annoying stuff that we do for the sake of the profession, but we don't do to help people run a successful business. And yet I got to stay somewhat within the realm of structured accounting to help people accomplish it and use the tools at bay, typically, programs like QuickBooks Zero and, NetSuite and all those. And so I really just started working through processes of saying, okay, well, here's the hierarchy. Here, and I cover this in the Simple Numbers Straight Talk Big Profits book, the first one I wrote 10 years ago. And I said, okay, there's basically 4 things that you've got to focus on to run a successful business. Number 1 is I got to clear distortions. And so what are the things that I'm causing in my data, either by myself or the direction of an outside tax advisor or somebody that, fine, I'm fine that if that's what you want to do for tax purposes, although I would argue that there's probably some reasons why you don't want to do it. But let's get to economic truth. And so that we're not having to do mental Olympics at the end of each month to know, did I make money or not? And so the first thing is typically owner compensation. I was talking to a client of mine this morning, a successful real estate agency down in South Carolina, and he had spoke to a group of his peers, and he was telling me that he just basically shared my message with all those guys about, the financial success that he's had in his business. He's one of the top agencies, in that region, and making really good money, and he doesn't go on any sales calls anymore. He doesn't show homes. He is running a business of other agents. And the classic, Michael Gerber thing of working on the business, not in the business. And, and these other guys, he's talking about the profitability that he hits. And these other guys, he's at, typically 15 to 20% profitability, true profitability after taking a true market-based wage. And these other guys are saying, oh, I'm making 40%. It says, well, yeah, but you're doing all the sales production. You're taking a $50,000 a year salary. You're not making 40%. You're lying to yourself. And so, and you see this all throughout. And we always just refer to it as, simply stated, if you got run over by a bus today and your family had to hire somebody to do your job, what would they pay them? And they might hire 3 people to do your job. They might hire a half a person. And I got news for you. I mean, all of us can be replaced, and some of us can be improved upon. And so there's a value number there. So we plug that number in, whether you stroke a check for it or not, do account for it, and look at the true profitability. Once you get to true profitability, then you've got to look at, am I at a sustainable level of profitability? In the first book, I did it by observation. We see hundreds and hundreds of businesses data sets. So I'm in a pretty good seat to see truth. And I said, in general, at 5% profit, you're on life support, 10% you're a good business, 15% you're a great business. And that actually is a pretty solid number for probably 70% of the businesses out there. Now, I now know, based on Simple Numbers 2.0, the why. And it really is your profit percentage target is really driven by the capital requirement that your business needs. Are you a high capital requirement business? I've got to carry inventory. I got to carry accounts receivable. I get no trade support from vendors. That's a high capital requirement business. So if I get paid in advance.
You need a higher profit in that case?
You need a higher profit.
Yeah, okay.
Exactly. Because I'm having to invest much more heavily than a business that gets paid in advance and always is cash flow positive. I can afford to be very aggressive and reinvest in that business because it has a super high return on investment and it's got a very low capital requirement. And we love those businesses. I mean, we've got some business models that have as much as a 200% return on investment year in, year out, just because of that structure. But they're rare, but they do exist. But you got to kind of look at your industry and say, what is that requirement? But that's now how we know how we set your individual profit target. We've got clients that are wildly profitable at 3%, but it's only because they're distributors that they get vendors that support their cost of goods sold. So they're never really out of pocket any of those costs. And so that top line revenue number is just a farce. I mean, it's really about gross margin.
And so when you say they're insanely profitable at 3%, you mean because they've got so little invested, the fact that they're making 3% is 3% net profit of the revenue is a phenomenal effort.
Yeah, and the way that we now get people to think about it, in a low gross margin business where maybe you're at 15% gross margin, your true economic top line is gross margin. So it's revenue minus your cost of goods sold. If you're a distributor, you don't make the product that you're distributing, and you get terms from the supplier who's having you resell them. And so as long as they give you appropriate terms, and I'm not really carrying the cash cost of my COGS until I get paid, I can afford to live at a 3% profit, but it turns out to be about 30% net profit to gross margin. Mm-hmm. That's why it's a good business, because it's a high volume, low capital requirement business. Now, if those things ever shift, and because the numbers are so big, then all of a sudden you're in a state of disruption. And if you don't understand the dynamics of the capital relative to the profit engine, you're playing with fire, because you have something that may be far more sensitive than you may think. Mm-hmm. And so like the chapter that I wrote in Vern Harness's Scaling Up book, chapter 13, I talk about these concepts. Well, also in that same book, my good friend Alan Milts, Alan talks about the cash flow story, and he and I are very much aligned on this idea of it's all about this working capital component. I call it trade capital for a reason, but it's dealing with these elements. These are the individual signatures that every business differs. It's the reason why when you get people together, they can't understand each other because everybody's talking a different language. Well, the language that you're really missing out, the piece that you need to understand is the difference in capital requirement. So like in my CPA firm, we changed the capital model. So typically in the accounting world, you do work, you build up work in progress, you build up accounts receivable, and then you bill the client when you get done. And when we changed to our consulting model, we changed to a fixed price model that's more like a managed service provider business. We bill up front, and we bill a consistent amount every month for a consistent amount level of service every month in our consulting services. And so we don't carry as big of a capital requirement as our peers, because of that type of work.
Because you've got no work in progress effectively.
Exactly. We stay equal to or ahead, in that process. Now you got to sell a product or service that the market's willing to accept that. And some products or services don't accept that. But yet we see, quite interestingly, businesses within the exact same industry that some are good at winning that feature from their customers to get paid faster or ahead, and others that just accept that, oh, well, nobody will ever do that. Well, did you ask? Did you present a value equation that got those people to pay you sooner? Because the part that really matters is, it's not about the profit percentage or the dollar amount of profit. And this is what the whole 2.0 book was built around, this idea of return on investment. And I want a return on investment of at least 50% or greater as a target. And we see most privately held businesses that are run properly, they're going to be a return probably more in the 75 to 100% range. And so who wouldn't want an investment that's making 100% a year?
Which, if you think, publicly traded businesses, poor ones doing 5, good ones doing 12, maybe?
Right, exactly.
So much invest in your own business, don't invest in stocks and shares. Is that your?
Well, I think it's one of the reasons why, when you see high return on investment businesses, that's also that marker of why that business is also can sell at a premium.
Yeah.
Because people look at it and they go, oh, okay, this has some legs to it that if a buyer can scale it better than you can. But what's interesting is entrepreneurs constantly, they have a good thing and they're constantly plagued by what I refer to as the belly full syndrome. They get things going to a point where it's good and they just lose that extra edge to scale and push it beyond that. Because it's like, that next dollar is too hard. Like, well, and that's their choice. I mean, I don't make that choice for them. I mean, that's up to them. I just educate them on what that next step is. But you see it in people that have locational businesses. People that have multiple locations. And it's like, we get within a region that we want to be, or I want to stay within a city or a state. And then it's like, okay, well, that next step, it's just too hard. It's just too much of a risk. And then they'll run it for a while. And then it's like, okay, then they're ready to sell it. And then somebody else takes it and they'll make it part of a bigger thing. But same thing in terms of whether you're, just other businesses that you get stuck on scaling and you look at it and go, I'm making enough that I'm just not willing to make a bet, to get to that next thing. And
so what's your calculation there for return on investment? So what's in, what do you include, what do you exclude? How should people be thinking about that? Because I guess there'll be some people watching this thinking, either live or the recording, thinking 100% return on investment. I don't think I'm getting that.
Well, it's really easy. So the first thing is you're going to take out that sheet called a balance sheet that you never look at as an entrepreneur. And you're going to pull that out and you're going to look on the bottom. If it's all on one page, you're going to look at the very bottom. If it's on 2 pages, you're going to look on the second page. But there's this thing called equity. Equity is the sum of assets minus liabilities. You're going to start there. And so now there is a financial term called return on equity, but return on equity is a very flawed calculation, because as an entrepreneur, you have a tendency to use your business to do things that aren't really necessary for the business. You own assets that the business has nothing to do with the operation of the business. You have tendencies to use the business as your own personal piggy bank, and do things of, loaning it money when it ought to be capital, borrowing money from it when it should be a distribution or a dividend. And so the first thing that you do is you take equity and you adjust it down for any dead assets that are not necessary for the operation of the business. Typically, shareholder loans, loans to related parties that aren't related to this business, or goodwill. If I purchased a business, goodwill is it's a fake asset. I mean, it's a plug number that says, hey, I paid $1 million for something that I don't have assets to back up. It's a hope and dream that it's going to produce profit, from its activity, from the rights associated to have it. And so you're going to take, those are the most common assets that you take out of equity, because you spent money, to get those assets. So I need them to go away. And then I'm going to look on the liability side and move those liabilities to equity, where I loaned money, I put capital in the business, structured it as a loan, but it really is capital. It is something that's not tied to, like a line of credit is tied to accounts receivable or inventory. A term note is tied to a piece of equipment or a building. There's a direct asset to debt linkage. In a capital loan situation, to kind of blend two terms together, you're putting money in a business. You might structure it as a loan thinking I'm going to get that money back. The reality is it only needed to borrow money because it's undercapitalized. And so that you move that debt down to capital. Once I've made those adjustments, what is left over is the term invested capital. So it's not equity, it is the invested capital that it takes to run an operating business. And I filtered out all the accounting hoodoo that makes it clear. And it's that number that you compare to your net operating income, or what's commonly referred to as Ebitda. So Ebitda as a percentage, Ebitda divided by invested capital is your return value. And it's that number that we believe should be 50% or greater for a privately held business. And if you don't have at least at 50%, I'm going to challenge you as to there's something wrong with your business model.
And why
now, even if you have investors, so if investors bought into your business, they're not going, we would take that capital that they bought that you took and then took off the table or something like that, and we would kind of normalize the balance sheet to just the operating assets and liabilities of the business. And so that's how we help a lot of PE-backed businesses keep sanity, because their balance sheet is just an atrocious mess because of the transaction. But you've got to have sanity of what are my operating assets and liabilities, what's my true profitability relative to that, and that keeps you focused.
And why Ebitda?
Oh, I mean, it's a commonly accepted term of return. Now, I will say that you use EBIT, or earnings before interest and taxes, if you have a high requirement for depreciation or depreciable assets. It's just the fact that we live mostly in a society to where depreciation is not a significant number for most operating businesses. But I do agree that if I do have a high capital requirement business, I would probably look at EBIT that is after depreciation, and a book depreciation number, not a tax depreciation number, because that's a true cost of assets that's being spread out over their useful life.
Okay.
Yep.
Okay. And so that was the thing that so that's in 2.0.
Right.
What else is new? Launch capital and labor efficiency ratio. You did labor efficiency ratio before, but you sort of come back to it again because you.
Yeah, I did a more deeper dive, but let me. So really, kind of think of it as in the first book. I said, okay, the first thing is you clear distortion, so I'm looking at truth. Second thing is I'm setting my profit target. So I gave some simplistic ideas in the first book that were from observation, but you kind of jump to the second book to get that return on invested capital to really tune that in. Really, the third thing.
Hang on, in the second book, then you've got a link. You were talking about invested capital business, low margin. Have you got, is there sort of a sliding scale in the second book where you sort of go, hang on, let's work, because can people
not necessarily. I mean, I think the idea is just understanding what your ability is to grow and how much capital requirements that as you start to scale. We do have some topics in there to help you understand, can you grow cash flow free and not use other people's money? Or am I going to have to first start off with debt to support growth, and then eventually, depending on the rate of growth, do I have to go get outside money?
Okay.
And those are pretty easily, we believe those are easily mathematical proofs. But once I get my profit target, so then we go into step 3. Once I know what my profit target needs to be and I'm not there, how do I do it? Well, there's one simple answer that's universal to all businesses. It's about the productivity of labor. So there is not a business in this world that does not produce profit relative to the output of labor. Zero. I don't care if you're a product business or a service business. It still takes the productivity of labor doing their job in the relative, whether it's direct labor or management labor, sales labor, marketing, pick whatever functionality of labor, but it still takes labor. And it is the isolation of what is the cost of that labor, and then what is their ability to produce margin output. It's never non-labor expenses that is killing a business in most cases. Now you can waste some money there, but at the end of the day, if labor does its job in every function, the business will be successful. And so let's just kind of walk through that and say, why is that? So I would tell you that the most important labor to get right is management labor. The people that generally are the owners and or the leadership of the business. It functionally, if those people do their job, direct labor will be productive. They're managing, they're doing their job. So management labor has basically 3 functions. I must drive revenue. And so we can look at all the myriad things that drives revenue. They got to control cost of goods sold. Am I, drawing a proper relationship of revenue relative to COGS? And am I managing direct labor to work off of the gross margin of revenue minus COGS? They have those 3 functions. That's it. That's what creates profitability. And if they get their job right, then you're just essentially then managing direct labor relative to gross margin production. That's kind of your governor of saying, okay, those 2 have to stay, in perfect alignment. And the reality is, I did this, we've got a model that we run. We've got a 100-company model of our consulting clients these are all US-based clients. We have clients outside of the US, but I don't include them in this. And we use it as kind of our insight to the economy, because there is no really credible private company economic data to speak of that's worth a flip. And the Fed just kind of guesses at it and makes interpolations off of public company data, thinking of what they think the private market is. And so it's just a pretty weak, representation of what's really going on. So we took this 100 companies. It's about $1 billion of revenue. So I'd say $1 billion of revenue is pretty representative, and it's all over the U.S., all different industries. And so it becomes our index. And when I was looking at it, I looked back and I just did this 2-axis graph that looked at revenue on one axis compared to all labor, regardless of direct or management, on the other axis. And when you put them on a 2-axis graph, guess what? Labor and revenue are 100% perfectly correlated. I mean, they are perfectly correlated. There is nothing else that matters in business. And so the thing is you got to understand, where are we at in the market? So when we have an expanding market of true gain of productivity, gain of demand, then revenue is going to pull labor with it. So as revenue goes up, I got to go add labor, add productivity output, and pull, and it's going to pull labor up. We're currently in a labor push scenario. Right now, labor's going up, and there's this ever so slight revenue decline that is now slightly under labor to where people are late to the game adjusting pricing. But it will adjust. It has to adjust, or else you'll cease to exist. And so those two things just work off of each other, just like a perfect, pair that's always going to be there. And it's the companies that know how to do it quickly and not be late to the party, and know how to do it elegantly so that I still win with the customer, but I win on the bottom line. Those are the ones that are going to win. And it's your labor management and output strategy that is the key to hitting that profit target that you set in step 2. And then
in that management labor efficiency ratio, you're including not just management, but you're also including sales, aren't you, and admin. So it's the
right.
Everyone who's not in the direct labor line is in.
The only time that we put salespeople in direct labor is if your business is sales. I don't make stuff. I just sell other people's stuff. Okay, well, those people are
right. If you're a distributor, sales goes in.
Right, that's right. But in most businesses, you're 1 or 2 salespeople or business development people, those kind of folks. We put those folks. That's not what you do. It is selling and marketing the thing that you do. Those people go into management labor, in that process. But at the end of the day, in the first book, I gave people a simplistic calculation that said, listen, especially if you're under a $5 million business, this is a remarkable data point. You can just take gross margin. So take revenue minus cost of goods sold, get to gross margin. Gross margin divided by all labor, regardless of type, should be around a 2. It's just if you're slightly above a 2, you're going to be probably 15 to 20% profit. If you're below a 2, you're going to struggle. There's a handful of businesses that can pull it off, but you got to be so skinny on the management infrastructure type cost of operating a business on a day-to-day basis that there's very few businesses that can pull off under a 2. Now, as you advance and you start to separate direct labor from management labor, so you're taking direct labor against gross margin, you're taking management labor against what we call contribution margin. So after direct labor has been subtracted from gross margin, is what we call contribution margin. And so that's why I say management labor is being held to this standard of a net number of productivity that comes out of your business engine. And so as you look at those numbers, then those are different ratios, but essentially those are going to vary by industry. So this is really where we've got several industries that we've got a lot of data sets on, so we can really hone in on those. And so as you hone in on those, you say, okay, well, this is the number you got to be at, or else you're not going to be in business very long.
And what's the spread of that? So the total thing is 2, so I guess it's more than 2. But does it get up to 10?
No, so typically what happens is once you split it, actually the output ratios get bigger. And so so for example, I'll give you one of the best examples early on. So we refer to him as client 0. So our client who was in the landscaping industry, he was the first one that we did the split of the 2 to study it. And so we came to the conclusion that he needed to be a 4 direct labor efficiency. So of his gross margin to direct labor, he needed to have 4-to-1 ratio for his landscaping and irrigation. He had a mowing division that he was only at a 2.5. Now this is the power of simplicity. So when I say that to financial people, as we say on the farm, they're like a calf looking at a new gate. They're just kind of looking at it going, huh? He explained it to his $10 an hour guy that does mowing, and the guy, his comment back to him was golden, because he was not burdened by sophistication. He just was very practical. He said, well, it sounds like to me we shouldn't be in the mowing business. And he was right. The mowing business just wasn't that profitable for the way that they were doing it. And so they actually ultimately just started contracting that out and just getting the margin for selling it, but not having to do it. And once again, this is this power of understanding this. What are the things that are worthy doing versus what are the things you want to get somebody else to do? You just make your margin off of not having to manage the complexity of that. And you see this throughout business today. There's a lot of businesses that are disaggregating their business model. They're breaking it down and saying, this is the part I want to do. I'm going to get somebody else to do this piece. And I got to leave enough margin in it for them to be profitable doing that piece. But it's just not worth it. That I don't want to do it. I'm not good at it. And it's kind of the old thing of, I've used this example quite often. If you're a manufacturing business, well, you're really two businesses in one. You make stuff and you sell stuff. You sell the stuff you make. Well, the first question I ask a manufacturer, are you world-class at making the stuff you make? And if you're not, maybe you should have somebody else make it and you just sell it. Are you world-class at selling it? If you're not, then you just get really good at making the stuff and get somebody else to sell it. And what is the part of it that you're really good at? And if you can't be good at something, that's where, you know, the business market is pretty flexible to, you can find somebody to do that piece for you. But there's a mathematical, economic way of looking at what is the value of that piece. And don't pay too much and pay enough.
And so one of the questions I guess that we get when, you know, where do we put people in which buckets? What, you know, how do you qualify yourself in your business? Are you management or are you direct? What percentage do you have to be to drop in which bucket?
Yeah, so good point. A couple of fundamental things that we always say. We refer to it as a butt in a bucket. So we don't like splitting people. So you're either direct or you're management. So that's the first one. Secondly, I would say if you spend 30 to 50% of your time facing the customer, doing whatever it is that you do, you generally should be in direct labor. You know, and even in my role, the way I look, the way I looked at our business, we merged with one of the top 20 accounting firms last year, and so, you know, I still look at myself as direct labor because I spend most of my time still client facing, even though I'm the partner in charge of the office that we merged in. Yeah, you know, I'm still very productive in that sense. So when I'm doing analysis of our business model, I consider myself direct labor. But in most businesses, the entrepreneur, the owner, and the key senior leadership roles are going to be management labor, and everybody else is going to be direct labor. Here's the thing. Don't sweat it. Just be consistent. Don't move people from one to the other. You know, just put them in one bucket or the other. And I always, you know, basically say, you know, figure out who's in direct labor first, and then by default, everybody else is in management labor.
And also don't gross their salaries up. Just take their net salary.
That's right.
It's complicated.
Yeah, I'm not trying to load it for payroll taxes or overhead or any of those things. I'm an absolute anti-allocator. I mean, I think allocation techniques in finances, in operations, is generally just a jobs program for accountants. I mean, we just take money and start moving it around and allocate it here and allocate it there. I believe in directly associated cost allocate. You know, so if I'm running a multi-segment set of P&Ls for a business, I'm really just identifying what's the revenue, COGS, direct labor that I can get. That's my number one thing of I'm trying to get a segment analysis on. If it's got its own full business line, okay, I might get into my other operating expenses, but I'm not trying to allocate corporate overhead. I want to look at corporate overhead as just its own cost bucket with no revenue. That's the easiest way, I think, to identify it. But I've got a really strong segment analysis chapter in the 2.0 book that really will walk people through. Here's a couple of examples of kind of level 1 analysis, level 2, level 3. And if you really want to go, the most powerful analysis in segments is actually understanding the margin that you create from that segment activity compared to the balance sheet impact. How much am I carrying in receivables and inventory and AP for that segment, and how much margin am I creating for how much I have to fund? And that's been eye-opening for a lot of our clients, because once they started to see that certain activities just weren't as valuable as they thought, because it was adding a little bit of margin, but the cash that they had tied up in it was just not worth it.
Okay, so and you also look at overheads quite simply as well. 4 buckets, I think, from memory.
Yeah, actually 5. So we look at, so in what we call operating expenses, but same synonymous term to overhead. Facilities, marketing, management, labor, all payroll, taxes, and benefits, and then other OpEx is just the catch-all bucket, for everything else, kind of the noise of business.
Do you, Mark? I know one of the things I was watching another webinar you did, and you were talking about one of the things that, just as you mentioned marketing, it just reminds me that one of the things that you said when you look at this, because you've got this big data set, that the companies that aren't growing as fast as they would like, often it's because they're just under-investing in marketing.
Oh, 100%, absolutely. Yeah, and we're huge fans of investing in marketing. Now, I will tell you, it's pretty much a crapshoot of how good people are at doing it effectively. And I think I really encourage people trying to find what are the marketing within every industry, who are the people doing it right, what are the techniques that really work. And there are some people that we have that do a really good job of it. But I really do think that the people who want to grow really struggle in terms of finding effective support, whether it's in outside agencies, and hiring a person to do some of it, just in general strategy of what is it that you're going to go do. But that shouldn't deter you. I mean, it really is, marketing is like going to the craps table. You got to go to it with a base enough money that you're willing to play the game enough cycles to hit the win and find it. And I think it works essentially that way, because for anybody to tell you that they know how to make something happen, no, I'm not buying it.
And do you think about marketing the same way as you think about launch capital? Like, is
absolutely.
So the return on investment in marketing is another way of using your launch capital idea to decide whether the experiment has worked.
Yeah, so launch capital, we talk about this in the 2.0 book, and so it's where we, as we say, we named the baby. So launch capital has been hiding in plain sight for centuries in business. We just didn't have a name for it. Because if you think of the term capital, you think it's balance sheet. I put money in to buy this asset, to fund this activity. The reality is marketing is an expense. Well, that's on the P&L. And so, and the way I always frame it, everybody who's listening to this, when I say this, I want you to think about your business for the last 12 months. What did you spend money on in the last 12 months that was a spend you expensed it in the last 12 months, but the benefit is going to be in a future period? By default, that's launch capital. I made a capital investment to intentionally lose money now to make money in the future, but it went through my P&L. It didn't go through my balance sheet. And that is really 90+% of the business growth of all the businesses we work with come through launch capital, not anything else. They are, and number 1 on the list is marketing. Number 2 on the list is hiring labor before it can be fully utilized, both direct or management. The third would be technology development. So one of the common things that's happening quite frequently now are people investing in their own operating systems that augment some base platform that you buy off market. But essentially people are finding there's no one system that truly works the way that they want their business to work. So they invest in system augmentation. Well, all of that is essentially tech dev. And some projects get out of hand, but it's because we track it this way. We look at it and we extract it from the operating performance of the business. And so to give a client clarity of where their business is working, I want to take all the launch capital spend in a period, take it out and put it below net operating income.
Okay.
That way, how is my normative business performing? Because if I'm throwing a bunch of launch capital spend into it that it didn't need to do what it did, I'm feeling bad about a perfectly good business that I'm just investing in the wrong things to get it to grow. Okay. And by isolating that cost below the line, and saying it's the number one use of profit. So the first use of profit after you generate profit is to reinvest back in the business. Because if this business is going to make us a 50 to 100% return, well, I want to invest in it. Let's throw some money back in and keep it going.
So you then, marketing is all below the line, or you put marketing above the line if it's needed for the general operating of the business?
Yeah, so there's kind of a maintenance marketing spend, but if I'm doing a surge spend, I'm really trying to push the market for future growth, not to maintain. Because there's people who have to market every month just to, so if I have to, do I have ongoing customers, or do I have to win a new customer every transaction? But so there's kind of a maintenance marketing spend that we keep above the line. But when I make a surge spend, I'm going to go attack a market. I'm going to open up a new location. I'm going to launch a new business line. Okay, that's a surge. That's a launch capital spend.
And then you want the return on that to not be dilutive of the return. You want it to be accretive. And so that says that once you know what your return is, you can then say, well, how much are we going to spend? And on this project in the next 12 to 24 months, are we going to get the return that we need to positively impact the return? So then you actually there's some things you probably don't do.
Exactly.
Because now you've got a mechanism to say before you start, should we just kill it here?
And I think that's been the power of the idea. There's a great case study in the Launch Capital chapter in the 2.0 book of an actual client of ours that used marketing spend as their catalyst. That was how they grew their business. This company grew from $700,000 a year in revenue to $10 million in 5 years, and they were profitable the whole time. Didn't use a dime of debt to grow. I mean, they funded their own growth, but they had one specific catalytic spend, and that was increasing marketing spend every year. And so now the way to hold marketing accountable is it's not the increase in revenue, it's not the increase in gross margin. It is how much did net income increase because I spent this money. And that's the true measure of did it work. And I think a lot of times people that want to justify their marketing activities, they pick a number that's too high in the value chain to justify. Oh, look at all the new revenue I got you. Well, was it good revenue? Were we profitable at that revenue? And just because it's activity doesn't mean it's good.
I've got another slight complication for this. So you might be, when you're thinking about the impact, say, of marketing, particularly in a recurring revenue business rather than a consulting business, or I mean, even in a consulting business, you might get repeat revenue even if you don't have recurring revenue. Do you include, second year, third year likely income into this thing, or are you just looking at what am I spending in a 12-month period? What do you think makes the most?
I'm trying to keep it simple. I mean, I really think people have overdone the lifetime value customer argument to justify a lot of bad ideas. And so I'm trying to say, listen, on an ongoing basis, if I spent $100,000 that I wouldn't have spent otherwise, did net income go up 50,000? That's as simple as I can get the equation. And I'll give you 12 months to get it there. But essentially in that second group of 12, that's from the 12th to the 24th month, I've got to see profitability being higher than the 100,000 that I risk, because that means that I've covered the 100,000 that I spent and I got 50,000 more.
So you spend 100, but you want 150 back. Otherwise, you're not getting the 50% return that is your minimum for your business.
Exactly. And like you said, once you frame it that way and you make people walk through the exercise, they'll look at, oh, that'll never produce that. And it's like, good, let's find a better idea. And it's like, just go to the next idea, because there's just not enough juice in that one, because they there's this high tendency to look at activity measurements in marketing. How many leads did I get? What were my conversions? And all of those. And it's like, all I need is dollars, folks. I mean, I can't take, I always like to remind people, so, you can't take a percentage down to the grocery store and buy groceries with it. I got to have dollars to buy groceries.
And your marketing, I'm just thinking about the way you expressed it earlier. Your marketing salaries are in the management labor. Line, and then your marketing activities are in the marketing line. But then when we talk about launch capital, that might be people and activities, I guess.
It could, yeah. You can extract, that launch capital spend can be in any of those categories, that you want to isolate and hold separate until it becomes a self-sustaining operation, in that process. So like, for example, it's easy to kind of think of it this way. If you're launching a new location, I'm not going to mix a new location that's losing money in with my existing mature locations, because it's just going to distort the overall performance. I'm going to keep the net of that activity isolated below the line for presentation purposes until that store gets to a positive, profitability.
In that 12 to 24 months period.
That's right. Well, what's amazing is, most locations actually do get profitable and start cash flowing in the second or third month in many cases. It's really, what's interesting in location businesses, it's the capital investment that is the barrier for people and that keeps them from speed of expansion. And this is kind of a good case of where you use the concept of understanding return on investment. So like one of our clients who was spending $250,000 to launch every new store that they decided to open, I was showing them, this is, well, the good news is when they don't own they just lease space and retail. And I said, so instead of you spending $250,000 of your own money to do the build out, if you can get a bank to, in essence, take the 250 and tenant improvements and spread that over 5 years and essentially turn it into rent. So this is a case where accountants fall all over themselves and get this really kind of messy. It doesn't have to be. That payment for that 5-year note of the build out is really just rent. I could have gone to the landlord and had the landlord include that 250 and let them finance it. Now, the challenge is when you go to the landlord to do it, they charge you about $100,000 more. And so to be more practical about it, you want to carry the risk on that. And some landlords just won't carry the risk, but it would be the same if the landlord was willing to do it and just charge you more rent. Well, the accountant would be happy to just show you have higher rent for 5 years and then drop down to a normal number. Why is it the same thing if you just go finance it yourself? It's the same thing. And so as we showed this client, I said, if you put your own money in, your stores operate at about a 60% return on investment. If you don't put the 250 in as capital, you count it as rent for the first 5 years, your return on investment goes up to 150%. Because you're not putting out $250,000 at the very beginning. You're at risk for it. I don't want to discount the obvious of that. But the belief is you're opening a location because you feel like it will last. And those are the capital barriers that keep people from expanding rapidly, is because it takes too much capital to launch it for the return that's received. And if you take the capital component out of it, you have a much lower barrier of success to launch and get that next location open and operating.
Greg, I've got some other stuff I could ask you, loads in fact, sure. But let me see if anybody wants to throw up a question on chat, and we can get you to take some questions.
Sure thing.
Anybody? Start typing, press enter. I'm sure somebody will throw something up, but in the meantime, while they're thinking about what to ask, one of the things that 100 companies gives you is, as you say, it gives you a barometer of the economy. So what are you seeing?
Something totally different than what you hear on the news media. So, what was interesting, because the original model, it goes back to 2013 as a base year. And so we started noticing it then. So we only used 50 companies, but it still continued to be the same result. And really the U.S. economy during, from 2014 forward, it's been at double-digit growth from what we've seen. ever since, except for 2019. So this is pre-COVID. Pre-COVID was the first year it had dropped to 8% growth. And my contention was, if you go back and actually look at what was happening in 2019 before COVID hit, is we ran out of labor. And I've already told you, the only way that revenue goes up is you got to have labor to be able, I mean, demand has exceeded capacity for quite some time. So then COVID hits, and there's this disruption in March and April and May, but then things kind of start to settle back in. We actually finished March of 2021. So the full COVID impact year compared to the previous year, we were up 9%. We weren't down. Now there's winners and losers. There's companies that were down. There's companies that were massively up. And this doesn't count PPP. This is just pure operating activity. So what we saw during that, though, were a couple of things that people can take to the bank. Number one is the companies that were very profitable, sustained it with little to no impact. They got efficient as soon as there was disruption in the market. So they trimmed labor. We saw kind of a quick trimming, about 10% of direct labor. Kind of go back to the Jack Welch theory back in the heyday of GE, where he said you got to fire 10% of your employees every year and fire that bottom 10%. Well, that's kind of what the best companies did, is they kind of looked at their ranks and skinny as much as they could. We only saw about a 5% reduction in management labor. Most people felt like their management teams were pretty hard to replace. And so they kind of committed and kept those people in place. But then you saw people kind of come back. And so really labor was up significantly for the year, because whatever they trimmed in those first 3 months of the hard lockdowns, they turn around and were really struggling to catch up and hire in that process. I still think that I don't see the growth. That 9% year over year, though, was probably almost all price increases. I don't think I don't have a way to measure, actual true output. But we talk about it a lot on every call with clients, and I think for the most part, a good bit of that's price increases, and still continues.
And probably driven by the 2019 labor shortage, because as you were saying, these things cycle, so it goes through. There's a couple of questions here. Callum wonders whether you see labor efficiency ratio as the replacement of productivity metrics such as utilization.
Well, absolutely. So LER, labor efficiency ratio, is actually, to me, the top measure of true output, because the two measures in labor are realization and utilization, and both have significant flaws to them. And so at the end of the day, I think the number one measure of true value of employee output is what revenue did they produce, or what margin did they produce, better stated, divided by what did I pay that person for all of their time. Not just their direct labor, what did I pay that person? So like in a services business like mine, I know the revenue by person. So our system adjusts write-offs ratably to everybody who worked on things. And so I can get down to true revenue by person, and I obviously know what I paid them. And so I've got a very strong LER by person. I know it by team. The four things that we do consulting, tax, financial statements, and outsourced bookkeeping. I know the labor efficiency ratio by each one of those teams. And, and the thing is, it's not a static number. It drifts up and it drifts down, and drifts up and drifts down, and some will be up and some will be down. And, because here's the thing about labor. Labor is the only cost that comes to work every day with an attitude. It isn't a constant output, no matter how good you are at managing it. And, but I think it truly is the number one true measure of economic performance when it comes to labor.
Okay, very good. And in fact, Callum's from Etch, and we started doing a project with them around. They've picked one of their products, one of their team's projects, and we're trying to see what labor efficiency ratio looks like for that team. But we did it for the whole company, and we could actually see somewhere what the labor efficiency ratio is and how it tracked back to net profit. So that's been really helpful.
Well, and the key is also as we look at data. So you have to be careful. If you just look at labor efficiency ratio as a static point in time, you don't know if it's good or bad. The key is if you watch it as it moves across time. So once again, I don't get hung up on as long as everybody's consistent about which bucket they're in. It's a true measure of, am I getting more output? Am I getting less output? And if I'm getting less output, why?
And I think one of the things you say is don't do it month on month, do it rolling 3 on rolling 3 on rolling 3.
Right.
Or if you've got a lot of variability over the year, do rolling 12.
That's right.
Yeah,
exactly.
For that reason. Alan Wick says, how do you think about R&D spending, capitalizing versus expensing?
So R&D to me is a launch capital spend. So it's a classic launch capital, and I like it below the line. Here's the thing about capitalizing. I mean, I think the financial world kind of falls all over themselves over it. I like to see it as a use of profit. And once again, I'm trying to also then hold it accountable. So I'll give you a good example. So one of my clients has products that they develop and sell in the youth therapy. They work with a lot of kids that have sensory deprivation issues. And so they develop products, for the therapist in that industry. And so they're constantly having molds made and then products produced. Most of these are plastics is the primary components. And so as they do product development, we hold all their product development costs down below net operating income. So we see how much he's investing out of his current stream of profits. But then we also know of the new product launches, how much gross margin, because in that case, there's no additional operating expenses for the next product sold. They have a systems in place. It's going to be there regardless. So we look at new margin created for the new products relative to that investment. And so far, he's done really good. I mean, he's well above the 50% return standard for all the new products that he's developed. And it's really given them a focus of going which products to focus on and which have legs enough that will sell enough at a good enough margin to make it worth the investment in the molds and the design.
Well, and Shelley from Frame's got I guess a similar question. She's in their business. She's obviously saying that they've got capital investment for a long time ago. So when thinking about, do you chase only ROI on launch capital? And she was just asking for clarification on, is the minimum 50%?
Well, so one thing we specialize in are what we call 20-year overnight successes. And so it's not uncommon for a business to go many years and have no return on investment, over that period of time. And, you could argue, was it possible? Was it not possible? But all of a sudden, once we get involved with them, all of a sudden they find a way to be profitable. And most of them will tell you that it's like, dang it, I should have been doing this a whole lot sooner. So I look at it as two things. You look at an existing business and say, of what has been invested, what are the things that I can do to make it at a proper, I can't fix what the last 15 years has done, but I can get it profitable with what I have today. I mean, when we do a consulting project, that's the number one thing we talk about is how do we get you profitable today of what you have invested? And are there enough knobs to turn? I would say in 99% of the cases, that's possible. You can at least get to a minimum acceptable return on investment with what's already there. And it was just change of thinking and change of framework. Then it's a question of, okay, well, what can I spend? Where is my most valuable spends to then improve the business even further? It may not even be in scaling. It may be I can make some investments and just be more profitable with what I got. And that's a possibility. If I can be more profitable what I got and scale, well, that's a double bonus.
Fab. That's magic. And that minimum of 50 on new products, that's because you think any entrepreneurial-led business should be doing at least 50%.
Right. Yeah, I'm trying to not, I want to make every new activity accretive, so absolutely.
Okay, I've got one last thing I'd like to finish with, because I think I've been retelling your story, but I'm not sure I've been getting it right. and you've got this example where you say you got a client $10 million in an hour because he was going to sell, but you persuaded him not to sell.
Yeah, it's my $20 million hour.
20 million. So look, I just thought we'd round it out. Tell everybody that story, and then we'll.
Yeah, So in the new book, I actually kind of go through the story in the new book. I call it the replacement return decision. And I'm actually pretty close to getting one that'll be probably about a $50 million hour here if the deal closes, but on the same thing. But essentially what it was is client, had built a great business, been client for 15 years. We'd been pretty much doing his work from the beginning. And, good business, very profitable, fully capitalized, no debt, cash flow positive. And, he says, I'm tired, I'm thinking about selling. He says, well, that's up to you. So he hires an expensive investment advisor to help him run a competitive offer. So they get 10 offers. 7 of the 10 came in at 40 million. And so, he comes to see me, and his advisor said, well, because 7 of the 10 came in right at 40 million, we think that's the market value. We think you should say yes. And so he comes and talks to me because he's on one of our consulting agreements. He can talk to me anytime he wants. And we sit down and I go, all right, here's the deal. It's not enough. He looks at me like I'm an idiot. And I said, listen, it's really pretty simple. I said, if you take 40 million after tax, you're going to clear $30 million. He was making 5.2 million a year in profit. And I said, the first question that you got to ask is, where can you take 30 million after tax and invest it and make $5.2 million in return annually?
Well, because you know what, somebody said to me, who can't live on $30 million? A guy who's spending $5.2 million a year.
Right, exactly. Yeah, because it works out to be a return of 17, almost 18% return. And I said, I don't know anywhere you can get 18% return that's legal, year in and year out. And I said, you might, but I'm just telling you, practically speaking, it's a framework to say, no, it's not enough. And so, so we went through that, and he goes away. A week later, he calls me back up and says, well, I got him up to 60 million. So, and he got him up to 60 million because he could say no. I mean, it's like there was nothing impending that, he could say, oh, I'm tired. He says, listen, you work 15 hours a week and 14 of those are not in the office. I don't think tired is the proper, description. I said, you might be concerned about the continuity of things. And although things actually in his business actually continued to grow, he actually it truly was worth it because it was on an upward slope and continues to be this day. And I said, absent of any dark clouds, I think you're just leaving money on the table. It's your choice. You make your own decision. I'm just giving you a framework of thinking. And I'll tell you, we've used this numerous times since I came up with the idea, and it's just provided incredible clarity to a potential seller to know what a good number is. Now, it doesn't say that, if you can't get to that replacement return number, because once he got to 60 million, you take 60 million after tax, he clears about, probably 48 million. And and then you take 5.2 million into that. Okay, that's a return that you can probably replace, potentially, with investments, but really at the end of the day, it just gives you a framework of thinking. And you start to understand that there's a reason why, when people get a premium in a sale, it's because somebody with money is willing to pay that price to get that return on investment. You can't sell it to somebody internally for that price because it would never produce enough cash flow to retire the principal. And this is kind of a big issue. So we just had one this past year. Client sold for a really nice multiplier. He called me up 2 years ago and said, hey, I'm thinking about selling my business to my employees. I go, well, that's great. Do they have any money? He says, no. I'll just sell it and take it back a note. He says, well, here, I ran the numbers for him. I said, at best, you could probably value it at 10 million. And I said, now you and I both know that if you put this business up, for sale to the highest bidder, it's going to be 25 to 30 million. How much do you love your employees?
You're better off selling for 25 million and giving them money.
Yeah, exactly. Well, and like I said, and I asked him, I said, well, how much do you love your employees? He says, not that much. And so, and they've just recently completed that sale at bigger than that price, actually. And so a lot of it is people just don't have frameworks of thinking about these things. And it's like, I'm not here to tell you what to do. I'm just here to quantify it. And once we quantify, you make your own decision. I mean, nobody should be able to tell you right, wrong, do this or do that. At that point, it is more so, here is the practical data. Now you make your own decision relative to that. And, and it's proven to be probably one of the, probably I would say second only, I would say the concept that we've come up with that I'm the most proud of is what our definition of a fully capitalized business. So what, and that number is you should have 2 months of operating expenses in cash with 0 drawn on a line of credit, or else you're not fully capitalized. And we firmly believe in running a fully capitalized business. And I would say that the pandemic proved that the stability of our client base was incredible compared to the market, because they had followed that full capitalization advice and they got through that disruption with flying colors. And I think being able to give somebody a definitive number of saying, this is how much cash you need to have in your business, and get that line of credit to 0. And I'm not saying don't have a line of credit, but use a line of credit for what it was intended for, not as a excuse of being sloppy with your cash.
Greg, another fantastic insight. That's brilliant. Thank you very much indeed for your time today, sir. That's brilliant.
Yeah, no, appreciate it. Anytime.
We'll put all your contact information in the show notes, and if anyone wants a copy of the recording, we'll get them that as well. We'll publish the webinar as part of the Melting Pot podcast series. So that's brilliant. Thanks very much indeed.
Super. All right. Thanks.
See you soon.
Good luck,
Cheers.
everybody. All right. See you. Bye-bye.